first rates will just start kicking in on your screen now. Let me just use my screen for reference to establish any more names here. And there you go. So the first rates are, it's uptick of 0.5% for the Sensex, uptick of 0.5% for the Nifty. The Bank Nifty also seems to be charting along very, very smartly. Now in terms of the real movers, Zomato, Indigo, State Bank of India. And look at the surge in Zomato. It's absolutely stunning, isn't it? Indigo 25, 24 like a minor response, and State Bank of India just about here, just about there. Stocks which are falling today, you got AU Small Finance Bank which has fallen. You've got, by the way, you've got Aarti Industries which has suddenly come up on my screen, 15% higher. Delta Corp 2% higher. Z Entertainment 3% higher. Vodafone is falling. BOB is falling. And then you've got Vedanta which is falling, largely because of how things are in terms of their corporate structure and things are moving. But the top draw this morning, I think, is once again Zomato.
Gaining ground even after that uptick on Friday. But Vedanta, the numbers actually were decent on a sequential basis. Revenue uptick of 6.5%. The adjusted margin as well has seen a 1% jump up. Interglobe Aviation, let's see what that stock is up to. Considering the numbers are above estimates, the guidance of 2% capacity uptick on a sequential basis is also something that they've highlighted. There's JK Cement, the sales volumes have seen an uptick of 22%. Aarti Industries, Crompton, JSW Infra, we were just chatting with the management too. Thermax, they've all delivered good set of numbers. In the meantime, let's also flag off what's not delivered well, and just going to highlight some of the stocks wherein you've seen some earnings disappointments coming in. So let's see what BOB is up to, because their names are at a 5-quarter low. The NIM guidance as well has been cut, and you're seeing a cut of 3.5% on BOB. Havells, the revenue, there has been an intelligence inspection which has been conducted at their offices. Bharat Forge, North America Class 8 truck orders have seen a slip of 10% on a month-on-month basis. Delivery as well, the net loss has only expanded for them. Gati as well. EBITDA is downtick of about almost 26%. PB Fintech, this is the one that I want to definitely flag off, because there was a net loss which was expanded. The EBITDA has contracted, but you're seeing a jump of 2.6% on the stock coming in this morning. Eicher Motors, they've opened a 90-day positive catalyst watch on Eicher Motors, one of the brokerages. And then, of course, there's CG Consumer, wherein also the PAT is seen a downtick of 23% on a year-on-year basis. So these are a bunch of stocks to look out for. But as promised, here's Christopher Wood, the Global Head of Equity Strategy at Jefferies. He got candid about his view on India and the world at large. And here's a slice of his interaction with Nikunj.
Foreigners, we believe global emerging market funds are only about 1 or 2 percentage points overweight India, which, given India's got, in my view, too low a benchmark weighting in the emerging market index, given the the strength of the Indian story, I think that's very, that is not overweight at all. That's very, foreigners could be a lot more overweight India. So any pullback in Indian equities, in my view, will be bought by foreign investors. Meanwhile, that's dedicated global emerging market funds, but there's a whole category of global equity funds who historically have not invested in India. It's now become consensus that the new long-term growth story in Asia is India, not China. But while this is the consensus, global equity funds are not positioned for that. So there's a huge potential in the next 5 years for global equity funds to start investing in India.
So do you see gradually, slowly, but surely, money will move out of China, move back to India? It could happen in 3-5 years?
Well, no, the global money is not investing in China.
Okay, it's not going there.
They stopped investing in China.
But do you see it coming out from China, going back to India?
When I said the dedicated emerging market money will stay in both China and India. But the global money was investing in China. In many cases, they've stopped investing in China for geopolitical reasons as much as anything else. And they haven't yet started investing in India. This year, global money that stopped investing in China actually probably went to Japan. But the problem is, if you're a global fund and you want to invest in India, if you're not set up to invest directly in India by FII, then you've got very limited options offshore because there's not many Indian stocks trading in New York.
Chris, Indian markets are trading at a premium, and the reason why we are trading at a premium is largely because of stability, political stability, a stable tax regime, a country where you can invest, and if you want to withdraw, you can withdraw. If there is a change of guard or change of administration in the next election cycle, May 2024, do you think that could open significant downside in the short term?
No, yeah, I think the base case has to be a sharp correction if the government's not re-elected. I think the parallel is 2004, which was a big surprise when it happened. This is a market with a lot of domestic money in, and yeah, I think that would be a big shock to the market. But I do believe the foreigners would buy on such a sharp decline.
What could be the extent of collateral damage if we have a change of government?
Well, an outright change of government like what happened in 2004, you know, total 100% surprise, yeah, I would say 25%, which is about decline, which is about what it was, I believe, in 2004 from memory.
So we pretty much would see that kind of a shock wave which may last for next couple of months.
But I don't think it would be a long-lasting, I think there would be a sharp rebound with a lag.
Why do you say that?
Simply because I think the foreign money will come in. And there'll be there will be an immediate shock, but then there'll be a realization that a lot of the changes made have staying power. But it would also happen at a time when India's economy's got a certain momentum. One key point is we're now entering our third year of a residential property upturn, which gives a fundamental momentum to the economy. That means property prices are rising. It means that the collateral of the banking system's improved. And we've seen this year, manufacturing, capex geared stocks do well, which is sort of signaling that the hopes are growing for more of a broader investment cycle.
Chris, I distinctly remember 20 years ago, or maybe 15 years ago, you had a research report which said the following, that looking at the size of the economy and looking at the market cap of real estate stocks in India, there is a mismatch. The size of the economy has become big, and real estate stocks in terms of market cap representation is low. And then we saw multi-year boom in real estate stocks. Could we see a repeat of that cycle?
Well, we're seeing that already. We're witnessing that. So I've got 4 property stocks in my Indian portfolio. We've entered our third year of a property upturn. Now, last year when the RBI was raising rates, the property stocks did very well, I believe, in 2021, when people recognized that the property upturn was starting after, I remember, a 7-year downturn. Then we had RBI raising rates, so the property stocks corrected. But although the property stocks corrected last year, the actual property upturn continued. The property upturn was not impacted at all by the monetary tightening. And then in the last few months, as the markets become more hopeful that we've seen the last of RBI rate hikes, the property stocks have rallied again. And it remains the case that, Indian property sector or Indian property stocks are very small relative to the size of the economic opportunity.
So if someone is watching the show and is curious about should you invest in real estate, which is buy a property, or should you buy real estate stocks? Would you say buy real estate stocks?
I would say you should do both.
Do you see the property cycle or the uptick in real estate cycle could last for next couple of years?
My base case, it can last as long as a downturn, which is 7 years.
Another 4-5 years are still left.
Because we've got a huge pent-up demand precisely because there's a downturn for 7 years. But the other point, we had the most, as brutal a consolidation in the property developer industry as I have seen, frankly, anywhere in the world. I've seen quite a lot of property downturns. But this was a pretty extreme downturn because beyond the normal just cyclical downturn, you had two specific catalysts which created a more brutal consolidation. I would say the first one was demonetization, which you could probably say amounted to a cold turkey for the property sector. And then the second thing, you had this very dramatic regulation or reform of the property market created by the Real Estate Regulation Act, RERA, which has caused a massive consolidation amongst developers. So the surviving developers are in a very strong position because so many of the competitors have disappeared.
Chris, for the longest time, you've had exposure to financials and especially private sector banks. And I can see while ICICI Bank, HDFC Bank are right up there, I want to be specific about HDFC Bank because they've gone through a merger. And markets are worried about the merger going through in terms of the return ratios, which could be under pressure. But the merger has not shaken your conviction. While HDFC Bank is part of your portfolio, it is actually half of what its representation in the Nifty is.
Oh, well, I'm not looking at it like that. So I've got a selection, but clearly this particular bank is at a much big, there's been a significant derating relative to history, right?
Yes.
So I think in a couple of the major Indian private banks, we have succession issues. So that's always going to create, create some near-term issues. But then you have the technicalities of the terms of the merger. But fundamentally, if global money does come into India, let's say, when I say global, non-dedicated emerging market money, I think the first sector global money will invest in India is the major Indian private sector banks because they are the domestic demand proxies.
AU Financial is part of your portfolio. Haven't seen this name in your portfolio ever. Why have you added AU Small Finance Bank in your portfolio?
Well, that's just a smaller growing, because one still can't have the portfolio everything with long, big established players. But as I say, as we were discussing earlier, I think the biggest challenge in an Indian equity portfolio, if you're running a relatively concentrated portfolio, so my portfolio is relatively concentrated, but it's between 20-25 stocks. The biggest challenge is what not to invest in.
So you think you have more ideas and less space?
No, exactly. I could easily have 40 stocks in my Indian portfolio.
So what do you think you wanted to add, you have not added?
Well, I have nothing in the auto sector right now. I have in the past. That's one obvious example. An area which did very well the last 2 years, which I was sort of familiar with, but I didn't put any money in there, was the defense sector. Then I could definitely have more in the power sector. I could have more in the engineering capital goods sector. Then I have almost nothing in the consumer sector. I have zero in IT services. So there's there's any amount of them.
But in terms of relative outperformance, since it's a tight portfolio, it's available in public domain, we'll put it out. You have a very strong concentration, which is 50%, 56% of your India long-only portfolio is in just 3 sectors.
Yeah. Now, my 3 areas I've been playing right of late is financials, property, and what I would define as capex related. So if I wanted to focus, but I'm running this quite structurally, less tactically. So structurally, I've always had the private sector banks in my Asian portfolio. This Indian portfolio was only created more recently, but my Asia ex-Japan portfolio, which I run, the Greed and Peer portfolio, which I've run since 2002. Yes. The one sector I always had representation since 2002 is Indian private sector banks.
And how has that portfolio done? What's been the return of that portfolio?
That portfolio has massively outperformed the benchmark, the Asia ex-Japan.
Okay.
So I haven't got the data in front of me.
In that portfolio, apart from private banks, what else do you have?
What? Oh, right now?
Right now?
No, right now I'm about 45% in India.
45% in India. And
roughly.
That would be a combination of these 3 sectors.
From memory, the dominant. And I'm about 15-18% in China. Then I have some semiconductor plays.
Okay.
But
45% in India.
But if I do an attribution exercise on the Greed and Peer Asia ex-Japan portfolio since 2002, the dominant where the alphas come from would have been predominantly in India.
We met in May last when you were in India, and that time you added Zomato to your portfolio. Now, while the classification is internet, I think it's becoming a consumer company.
Yeah, that's wrong. It should be defined as consumer.
Do you think a company like Zomato has a long way to go? Because even the run-up in Zomato has gone from 50 rupees to 100 rupees, the market cap actually still way below $20 billion.
Well, the interesting thing about when I last checked this, the Zomato market cap is way lower than the nearest equivalent in China, which is Meituan.
So do you think it could become as big as
Yeah,
Meituan?
the key issue, if these stocks actually start making money, then they become very attractive.
For the longest time, you've argued, Chris, that India has one problem, which is that the capex cycle was not in full bloom.
Well,
But-
since 2009-10, yes, we've been waiting for a new one.
But now it has started. Now you can see
We're
evidence
hoping
of
it
that.
started.
Are you convinced that it has started, or you are waiting for some more data?
I'm kind of 80% convinced it started.
The fact that you've got L&T, you've got Thermax in your portfolio, is that an indication that you want to bet on the capex cycle?
Yes, there's a case I should have more of these stocks in the portfolio. Well, in the short term, in the short term, these stocks are performing better than the private sector banks. So actually, the best indication that there could be a capex cycle could be beginning of greater scale than what we've currently seen is the performance of the capex geared stocks.
You know, your famous newsletter, Greed and Fear, which is like the go-to newsletter we always read every time it hits our mailbox. So if you have to use the tagline of your newsletter, Greed and Fear, to your mind, which asset class, if you can cut across all asset class, there is greed built in, which asset class has fear built?
And the greed is where the greed is most built in right now, it would be private credit.
Okay.
That's where there's the maximum greed. I think the maximum fear right now is probably in China. So China's on about 9 times earnings. And while China's got a lot of problems, I personally don't believe the Chinese situation is quite as extremely negative as what you've been reading about in the Western media in the first
Do you
half of this-
expect China to come back then?
What, the
Do you
stock
expect
market?
Chinese stock markets to come back?
I think if the Chinese property market stabilizes here, it's bottom for the moment. So
And- You think flows will come to India irrespective of what happens to China?
definitely no. China's in a lower growth trajectory for the next. China's growth next 10 years, 3-4%, maybe 4's at the upside, I would say. Whereas India's growth is 6-7% or potentially higher.
Chris, when you meet fund managers, every fund manager is a different risk and a different time horizon. And sometimes you really have to tailor-made your advice based on risk and time horizon. So allow me to do that. I'll phrase my next question differently. So if you have to identify a short-term trade for our viewers, when I say short-term trade, 3 to 6 months, which one would that be? A medium-term investment, 1 to 3 years, and a long-term investment, let's put a number there, 3 year plus.
Sorry, what's
3
the-
buckets.
what's the first-
First is short-term, less than 6 months.
So in less than 6 months, people should look to buy gold and Bitcoin. For the very simple reason, I would expect adjustment. And based on my view, the monetary tightening impact is going to kick in on the next 2 quarters. You should buy gold and Bitcoin because it will respond to any change in Fed policy. But if you're a millennial, you won't want to buy gold, so you should buy Bitcoin because there's a halving of Bitcoin. Can Indian people trade Bitcoin?
You can buy Bitcoin.
Yeah, so basically the halving of Bitcoin's coming up next year.
Yes.
And I believe it's not a precise timetable, about April, May.
The volatility will come down.
But all the precedent is you make money if you buy ahead of the halving.
Okay.
So on the 3 to 6 month period, I would say, gold mining stocks and Bitcoin. And then on the
1, 2, 3.
on the other 2 environments, I'd buy Indian equities.
So for the medium term, which is 1 year plus, and for the really long term, which is 5 year plus, you would buy Indian stocks.
Yes.
Okay. And would you be again advocating that anybody who's got a long term time horizon, which is 5 year plus, the focus should be, according to your portfolio, real estate, it should be largely capex driven, and it should be financials. 3 sectors should
But
form half of your
that
portfolio.
can change.
But as of now, that's your view.
As of now, that's my view. But my key point is, yes, any correction from external sources in India should be bought, and even a domestically driven correction, which the only real plausible driver of a sharp Indian domestic correction to me would be relate to the election, and even that is an opportunity to double your exposure.
Couple of last follow-up questions, Chris. Okay, so India is where you want to be in, but let's talk about how much of the good news or the template what we've discussed is in the price, because that also becomes an important indicator for investors. So the last 5-year returns for Indian stocks versus next 5-year returns. Do you think the future return of next 5 years would be higher than last 5 years?
Well, it's not like the returns have been dramatically high.
They've not been very high.
No, so I think, yes, they can be that. So obviously, if you look just at the mid-caps, the returns have been better, but the valuations are much more elevated in the mid-cap area than they are in the blue chip area.
So Chris, what you've said that the problem for you is that you can have select few stocks in your portfolio, and your portfolio right now, if I count the numbers,
yeah, how is it? How many is it?
It's actually not even. It's not even 20. You've lost less than 20 stocks in your portfolio.
So I think maybe I have to increase the numbers a bit.
But I have a reverse question. If I put a gun to your head, sir, and if I say, Chris Wood, you're only allowed to buy 3 stocks, only 3 stocks.
I have to think about that one.
But would that be only financials?
For what period? For what period?
Let's say 3 years plus.
On a 3-year period, it would have to be the financials.
3-year plus, would you buy just financial stocks and say, okay, I have a concentrated portfolio, I'm happy with it?
Well, I can't sell in that 3 years.
Okay. What about next 1 year?
No, next 1 year I'm sticking with my current portfolio.
And 5-year plus, would you buy property stocks?
On a 1 year, 3, I'd just have one I'd have one stock from each area. You know, capex, property, financials.
Okay.
But on a 5-year, I'd just have financials.
So Chris, you've been coming to India for almost 2 decades now, and when you look at India, what has delightfully surprised you about India? What has surprised you, and what has disappointed you about India?
Now, what's been very dramatic, I would say, is the development of the financial markets here, the capital markets, the asset management industry, and all the variations of it. I think that's been very, very dynamic.
So when Chris Wood is not traveling, and when he's not writing his reports, what keeps him busy?
Well, I have to write the report weekly.
Which is one Indian dish, and it's Diwali, it's food time, festivities, good food. What's your favorite Indian food?
Oh, favorite food, Indian food, Rogan Josh.
What about Indian sweets?
I don't eat sweets.
Welcome back. Well, let's talk earnings. And of course, Titan was one number that was quite glittering, especially with the EBITDA performance that the company has reported in the jewelry segment, which continues to grow almost 19 to 20%. Ashok Santhalia, the CFO of the company, joins us to talk to us about just that. Ashok, hi, good morning. Thanks so much for making time speaking with us. Well, the festive season this time is falling in Q3 versus Q2 that we had seen last year. But so far, given that we are halfway through the festive season, how's the demand looking like? Are you seeing that festive cheer and festive mood in the consumer sentiment as well?
So thank you. Yeah, the first 15 days, of course, if you know that from last year compared to this year, the Shraddh period had shifted to Q3. So it was slightly slower, and even gold prices have become volatile because of the geopolitical situation outside, India, what's happening. But I think things have settled down since then, and we see good demand coming up, towards second half of October and beginning of November. The mid premium, high value are showing very, very good traction, good demand, growth rates are very high. In those segments, consumer numbers are also kind of growth is high. Entry level is a little bit still, I would say, the whole discretionary aspect at the entry price point, that target segment of consumer is still yet to see the whole thing panning out. But early signs are very good, and we are very, very positive about Q3 and the Q4 shaping up well.
Sure. Okay. The other thing, Ashok, that I wanted to talk about is the jewelry EBIT margin, which has been very strong this time as opposed to the last quarter. Are these 14% kind of levels sustainable given the high competitive intensity as well in this segment?
Yeah, on a full year basis, it is 12 to 13%. Our focus is more on growth, market share gain, number of customers coming to our fold, and delivering a consistent margin profile, which is 12 to 13% for a full year basis seems to be more right. Q2 is more diamond studded activation quarter. So margin profile of Q2 is slightly elevated every year. So 12 to 13% is more reasonable band to aim for.
Premiumization has been the big trend over the past 1 year. Have you seen that trend for a company with high ticket size jewelry seeing more demand?
So, we generally look at sub 50,000, 50 to 1 to 2, 2 to 5 lakhs, and 5 lakhs and above. There is no upper limit. There are transactions which happens in couple of crores also, and 5 lakhs and above we generally treat as a more premium category, and that is how we kind of monitor our data. Certainly, 1 lakh to 2 lakh, 2 to 5, and 5 and above are doing extremely well at this point of time. We see a little bit, and that is what I was referring to, sub 50,000, where everyday diamond jewelry or gold jewelry are sitting. There, the growth is slightly slower, but still, I would say that Mia and CaratLane are doing well. Ambitions were maybe even far higher. CaratLane has delivered 45, 46%. Mia also within Tanis, the number is not separately available to you, similar kind of ballpark. And 45%, 46% by no means is not a good growth rate. But yeah, ambitions are even more, and those we are finding not coming so easily.
Sure, you talked about CaratLane showing a good growth of 45, 46%, but what about the road going forward? What's the strategy you have outlined for yourself when it comes to CaratLane?
So, when we kind of increased our stake and announced that in the month of August, then we have talked about that we see it's a very long opportunity, unfolding opportunity. First 10 years of CaratLane, when they started, and first 10 years have one phase, and next 10 years is going to be another phase. In first 10 years from a starting in a completely digital company, they kind of came to Titan fold in 2016, and the next 6-7 years, they have truly emerged as an omni company, which has a digital and then a good network of physical store and able to connect it very well. Still, the default for their customer is first to go digital, do the search, and finally maybe come to the nearby store. Now we believe the next 10 years, that strategy is going to continue. Their physical network expansion will definitely happen next 3-4 years more aggressively and then stabilize. And of course, the whole digital method of kind of reaching out to customers. Along with that, the brand building, and with the help of Titan, more, I would say, not tighter integration, but our backend support to them on some of the sourcing things, some of the other processes will be slightly higher than what it used to be. So we believe with more closer support coming out from Titan for them, next 10 years for CaratLane seems to be very, very promising to us.
Right. Your company's current market share is around 7% in jewelry segment. What do you think is the market share that you intend to clock by FY25? And what's the strategy then for the near-term store expansion?
So, it's very difficult to give you a number by FY25, but by FY27, when we had some time back talked about our ambition, we believe that we can reach towards 10% or be around that, with all the 4 brands which we have in our kitty. As far as the store expansion, if you look at this year trend, we are 40 Tanishq store, some 50 Mia and 50 kind of Carrot Lane, as well as Zoya, which used to be 3 for many years, is now 8 and can be by the end of next financial year, should be around 15, 16. So all channels, all formats, all brands are kind of looking at expansion rapidly. International is actually doing pretty well for us. We are already 10 stores were there by Q2, and as we are speaking, we are already 13 stores. 2 more stores we opened in Qatar and 1 in Singapore. In US, I think 3 stores more are coming up in this financial year. So all in all, not only network expansion, everything else which we do, whether it is GP, TP, gold exchange program, our gold harvest scheme, the whole focus on innovative design, adornment, and the customer experience part of it. So all things come together, and regionalization strategy, wedding strategy. So there are several. I don't want to talk about everyone, but all put together, we kind of see a good progress and future, not only in India, in the international market as well.
Okay, and talk to me about studded jewelry as well. The contribution of that segment is right now at 33%. Is this likely to be the range in Q3 and Q4 as well, given the demand you're seeing?
No, so like Q2 and Q4 are more where we promote diamonds in big way and there is a focus. Q1 and Q3 are more gold, where, because they are more rooted into the cultural auspicious thing, Akshaya Tritiya, Dhanteras, Diwali. So people, while they buy diamond also, but they prefer more gold and gold jewelries. So we believe overall, like Q2 is 33, Q3 could be 30, 31. So overall annual, we are not seeing too much change, that we are kind of 30% range for diamond, 30, 31%, any number can come out. Very difficult to predict.
Right. With the increase in the demand for synthetic or lab-grown diamonds, are you seeing any sluggishness in the sale of, earth diamonds in India or internationally?
So, like in India, we don't see anything, so far. No customer is asking, at least to us, about lab-grown diamond. In the US market, the bridal jewelry, which is generally the engagement ring, contributes to 40% of diamond jewelry market in US. Out of that 40%, we do hear that 20% is kind of, so 50% of that bridal segment has been getting replaced by the lab-grown diamond, because lab-grown diamonds are cheaper and you can get a bigger stone on the same price of natural diamond, which you are paying, and maybe slightly lesser than that. So that trend, we are seeing that. But in the natural diamond space, the price corrections which has been there or people have been talking about has not just because of LGD. There are many more reasons which has actually caused that, the inventory buildup which has happened in the past. Lab-grown diamond is one of the contributors in that. We, as you are aware, we have a minority stake in a US-based lab-grown diamond jewelry company. And the whole idea when we invested 2 years back was that only, that we want to keep a very, very close and keen eye on the development of lab-grown diamond in US market and appropriately decide on our response. We don't see anything to be done in India immediately, but we will be watchful, we will be ready to respond to evolving situation.
Yeah, but even in terms of the natural diamond prices, there has been a significant, fall in that as well. Will it impact your company in any way in terms of, let's say, the inventory losses or the pricing or something?
So, the diamond price corrections have happened generally, I would say, on a 1 carat and above category, larger diamonds, the correction has been there. Smaller diamonds are not that much impacted. And the predominant business of Carrot Lane, Mia and Tanishq is on the smaller diamond side, our jewelry. We do have solitaire business where there is certain amount of inventory where the corrections have happened. And we believe that correction, and we have also in response to that have taken some correction on our prices, which will flow through for the next 2 quarters to my mind. But it is not material enough for us to be worried about and to be calling out it that whether our margins are shifting and our guidance is changing. No, it's not like that. Some impact is there, which will flow through next quarter 3 and quarter 4. And after that, the fresh inventory, will come in the cycle. But it is not very material for us.
Sure. And any specific trends that you're seeing in watches, wearables, your eyewear business?
So premiumization is a very well-established kind of trend across lifestyle categories. We see in watches, analog watches, where Helios and Titan brand is doing very, very well. Helios is a channel where we sell international brands and doing extremely well. So demand for premium watches in analog segment is very, very robust. And Titan is also taking certain action. We have been on that journey for some year, but taking it even ahead and far above, we are working on. Wearable is exploding segment in India. India has become the largest smartwatch country globally in terms of number of watches. Okay, and we have been kind of playing our game last 18 months very, very well. That business has become now 17% of watches and wearable segment, our business unit, which was 10 years, 1 year back. And that we believe will continue to grow at least for 2-3 years like that. The other businesses, eye care is doing nice, profitable, opportunity is large, but we would like it to grow faster than what it is growing right now. But they are coming out with a lot of innovative products, looking at their portfolio, etc., etc. While eye care remains a core anchor for them, that we want to be expert in eye care, but at the same time, fashion, youth, sunglasses, etc., etc. They are re-looking at their portfolio and doing some stuff around that.
Okay, Ashok, on that note, we'll let you go. Thank you so much for making time and speaking with ET Now. In the meantime, wanted to flag out the pre-open rate for Seller World. The listing is, of course, likely to happen in the next 5 to 7 minutes, and it's going to be a bumper listing at that. 28% uptick is what it is suggesting, above the mark of 829. So we'll track that listing when we come back, but slipping into a very short break.
Back with the market right here in ET Now. Let's just revisit what the market has settled in at, because it was a smart start, and from there we managed to hold on to the gains of about 0.5%. Of course, it's a little bit tempered as to what the handover from the GIFT Nifty was, or for that matter the global cues as well. iShares, Coal India, Hero MotoCorp, Axis, ICICI Bank, L&T, these are some of the Nifty movers in trade. But SBI, that's petered down after its numbers, down about 0.6%. Titan, we were just chatting with the management, that's also lying flat, and you're not really seeing much of a move on an ONGC, on an IndusInd Bank, Maruti. These are stocks flat to just about marginally higher. But let's focus on Electronic Smart. We've got Premchand Devarakonda, the CFO, joining in on the show right now. Mr. Premchand, great to have you on the show. Let's talk about your numbers. And your revenue growth has come in at about 7% during the quarter. With the beginning now of the festive season, do you think one could expect double-digit sort of growth in the second half?
Good morning. Yeah, during the first half year, we achieved about 14% growth, and we are quite confident that the same growth rate could be maintained during the current, second half of the current financial year. And in fact, when we compared the Navaratri sales of the last year with the current year, so there has been significant. There is about 15% growth, which is quite impressive.
Which segments are seeing robust demand, and what do you think would contribute into this uptick in the second half?
See, air conditioners, dishwashers, home theaters, mobiles. These are the 4 categories having almost, on an average, more than 20% growth. And if this trend continues, definitely whatever we targeted for the current year could be easily achieved.
But let's talk about margins as well. I think the margins this time were around 7%. Is that the kind of range we should expect for the rest of the year as well? Or are they likely to head towards a double-digit mark, maybe in FY25?
See, that 7% is the EBITDA margin. So that is maintainable. And when we draw a comparison between North and South, we are very young in the northern market, that is especially in NCR. So there the EBITDA is about 0.4%, and whereas we are earning, rather our EBITDAs are quite impressive in the southern markets, which is about 7.9%. And the blended average of our EBITDA at the company level will be over 7% by the end of the financial year.
And, the newly launched Easy Kitchens as well. I want to know how that segment has been up to. Because, one has heard about, again, the premiumization trend playing out there as well. And kitchen upgrades ever since COVID, in fact.
There is definitely good response from the market. And our presence is very limited. Currently, we are focusing in Hyderabad market. There we could see decent growth as compared to the last year. I mean, in absolute terms, it is 200%. But when you look at the volumes, it is not significant. And we have been discussing with a couple of developers for the certain turnkey projects. And those projects, the revenues from those projects will kick in the last quarter of the current financial year. And by the end of this financial year, definitely there will be decent contribution from the kitchens business.
Okay, Mr. Devarakonda also talked to us about overall in terms of the expansion plans. You already have a stronghold when it comes to the southern part of the country. Are you looking at expanding a geographical presence as well?
At least for the next 12 months, our focus will be on NCR because there we are quite new and we have to establish ourselves in the NCR market. Then we will look at the other options and there will be an organic growth in the existing markets like AP and Telangana markets, and that will be ongoing thing. And at least I would say for next 12 months, our focus will be only on NCR.
Point taken. In fact, in the meantime, I also wanted to point out Celloworld's listing. Just hold that thought, Mr. Premchand, because it's seeing a bumper listing right now. It's up almost 800, above the mark of 800 rupees. Almost a 25-30% gain coming in versus its issue price as well. Of course, we have seen that recently, whichever are the IPOs which have been priced well, they have been getting a good listing. And today, of course, it's a good day to list. I think overall momentum is on the positive side, Ajay.
Well, that's correct. When you price your IPO at 25 odd time or lower than that, when the sector average is around 35-40, and plus there is tailwind. I mean, this entire sector is witnessing very good tailwinds. And look at the entire family jubilating out there of Cello management. 25% gain in a week is actually, if you got lucky. How was the subscription number? Do you remember? Yeah. I think it was okay. Yeah, it was not like blockbuster.
3 point something.
The probability to get, if you apply 3-4 applications in a family, was pretty decent, right? Yeah. So good Diwali, good handy, gains coming in over there, about 25%. It'll be interesting to see whether follow-up buying comes up in this category.
Yeah.
So 25% gains coming over there. Management will also join us very shortly after later in the day actually. But
actually, I stand corrected. Ajay, the subscription figure was 38 times actually.
And out of that, retail would
have been lower, I guess. But the overall subscription was quite high. And yeah, that's the reason.
Then the probability of getting it would be on the lower side, right? It's the reverse.
Correct.
You'll have to apply more than 3 applications per
Friends
family.
and family.
Okay, so that was about Celloworld. Let's do one thing. Let's slip into a very short break because when we come back, we discuss with more managements about their earnings and get you more stock-specific action as well.